business and sole proprietorship, Schedule C. If you've incorporated a different company, then you go to other forms of taxation. Okay. If the rental is for more than 15 days, now we are going inching closer to the fact whether it is a personal come rental property. How do you do that? We say, okay, you've rented it for at least 15 days. So it is a property which has been giving you a rent, which is a little significant because now I'm noticing that property. But at the same time, you've got to use that property also for your personal purposes for greater than 14 days, 10% of the rent days. So at least 14 days. But if you've rented it for a lot, let's say you've rented it for 300 days and you have used it, so you should have used it for personal reasons also for at least 30 days. If you've not done it, you're not going to treat that property as a personal come rental property. Okay. So first, you should have used that, rented that property for at least 15 days. And you should have also used that property for your personal purposes for a greater of 14 or the number of days that you've rented into 10%. So if that criteria is met, then I'm going to treat that property as a deemed personal rental property. Now comes the most important part. What is the benefit? Why should I get into this kind of a tax hassle? You get into this kind of a tax hassle because see, this anyways you were getting as a deduction, right? This is not a problem. The problem is, and the benefit is, all of this which was outside the tax net, the moment you go to a deemed personal come residential rental property, you will be able to take some part of this as a deduction if it is a deemed personal plus rental property. And how do you do that? Now see, the first part, I'm going to continue it the way it is, okay, which means I'll take the mortgage and the property taxes. So if let's say for simplicity purposes, I rented it for 3 months, and out of 3 months, I used it for personal purposes for 1 month. So what will I say? I'll say, okay, it doesn't matter whether it is for 1 month or 3 months. I had to pay the mortgage interest and the real estate municipal taxes for the full year. I used it for rental purposes for 2 out of 12 months. So I take the entire period, and only for the period for which I have put it on rent, I will segregate it and I will knock it off against my rental income. The others, I was anyways taking it to my itemized deduction schedule A. I will continue to take it there as an itemized deduction. Okay, so that's the first part, which has not changed the entire amount that I was taking earlier. Now I'm just splitting it between what goes to Schedule A and what goes to your rental income, which is Schedule E. This is what is the delta. The delta is all of those property, all of those utilities that was being completely ignored earlier. I will be able to take some part of that now as a deduction. What is that part? That part is I now use that property for 3 months out of total 12 months. And out of those 3 months, I rented it for 2 months. So only for 2 out of 3 months, I would be able. So 2/3 of the expenses that I'm putting on insurance, on utilities, and on repairs, I would be able to use it and knock it off against my rental income. Now, this I have a question, and my suggestion is let's do it through a question. If this registers in your mind, this is the max that, or it is the most complicated that it can get thereafter. Okay, I will do a question for this. Please understand the rental use expenses are deductible only to the extent of rental income. You cannot have a rental loss on account of this. If there's any excess, you can carry it forward in the future period. And then when you get a rental income, which is again passive, you can knock this off against your rental income. Okay, let's take a question here. Janet rents her vacation home for 2 months and lives there for 1 month. So her rental period is 2 months and her personal use of the property is 1 month. So if you look at the rental personal use, it is greater than 15 days. Great. And of the period that you have rented, which is 2 months, 10% of 2 months or 60 days is 6 days. Then definitely they have spent more than that. So this becomes a deemed personal come rental property. During the other 11 months, so she went and stayed in that vacation home for only 1 month. And since it was vacant during the season period for 2 months, she just rent out that property. She lives in the city. Her gross income is 6,000. for real property, taxes and interest. The moment you hear tax and interest, I know it is segregated. I'll keep it separately. So I'll put this in one bundle. And then there are utilities depreciation that I will put it another. Okay, so here, what do I have? I have the rental income, which will come to Schedule E. And then I have my personal, right? So this is my personal use of the property. This is my rental use of the property. Okay, so let's first assume how much was your gross income. So my gross income will only be for the rental period. It will not be applicable for the personal period. So my gross income was $6,000. Then I go to my first category, which is my taxes plus my interest. Taxes plus my interest. So if I take a summation, this is 6,000. Taxes plus my interest came to 6,000. Again, 3 to 5, 6,000. And out of this 6,000, what will I do? I'll split it. Why? For the rental period, I used it for 2 out of 12 months. And for personal, I used it for 10 out of 12 months. So I will split it, and then 1,000 will go for my rental and 5,000 will go to my personal. Now this I know is Schedule A because my itemized deduction for taxes and interest will go to Schedule A. Okay. Then I go to the next category, which is utilities, depreciation. How much is it? It is 7,200. So this is 12,000, exactly the double. I'll take 12,000. Okay. Now between utilities and depreciation, depreciation will be taken in the end. I will take utilities first and then I will split the depreciation. So how much will that be? So, okay, let's take it separately. Then you will know that it is the depreciation that you're knocking off and taking it for the next year. So let's first take the utilities. I take the utilities and how much? Out of 4,800. Now, this will be according to annual usage, not according to annual period. The idea is when people are staying in that house, then only they will switch on the light and the fans, and then only there will be some utilities. Otherwise, there will not be any utilities. So for rental expense, it will be 4,800, but it was for 3 months and I have used it for 2 months. And for personal purposes, it will be 4,800 for 1 out of 3 months. So here it will be 1,600 and here it will be 3,200. Is this clear? And then in the end will be depreciation. And if you look at depreciation, it is 7,200. But by this time, what is the balance that is left? So we were left with 5. Now we are left with 1,800, right? So this was the balance which was left. And the balance which was left here was, we started with 5. So there's nothing here. Okay. So now out of this 1,800, if you look at 7,200 for depreciation, again for depreciation, you will take 2/3 for personal property, 1/3 for 2/3 for rental property, 1/3 for personal property. Okay. So it's 4,800 and 2,400. But out of this 4,800, you can knock off only 1,800. So basically, you will not report any rental this year. And out of this depreciation, 3,000 will be knocked off in the future years. 3,000 will be there. And in future, when you get a rental income, you can knock off this 3,000 against other heads of income. Now here, for utilities and for depreciation, okay, nothing will be allowed as a deduction. If you look at it, nothing. Why? Personal expense, nothing is allowed as a deduction. Is the concept clear? For personal, nothing. For your depreciation, utilities, rent, and so on. For rental, you will split. And for the first part, which anyways you were getting earlier, nothing new now, you will just split it between personal and rental. So you'll reduce what is going in Schedule A and you'll put it in Schedule E. And for the utilities, depreciation, and stuff, you will just take it on the basis of the number of months in which the property was used. And for the rental use period, you will just take the usage for the rental period and then you will split it on the basis of the number of months in which you've rented out the property. But a rental expense will be allowed as a deduction only to the extent of rental income. Any balance you can set off for future rental income. Why? Because rental income is a passive income. And the general rule is passive losses can be adjusted only against passive income. I think if you can do this question properly, you'll be able to do every question in this area properly. But just be alert. Alert of the fact how many days. So, you have to understand the question. That, oh, this is the question that has personal and so keep that angle in your mind. I think it'll be okay. Now, this is also very important because now when you're going to do business, you will see they have increased a lot on these concepts, but they're going to test you on deemed personal come rental residence. Now, if that happens, if it is not business come personal residence, and for business use of home, they are going to allocate something and allow. So there again, we are going to use these concepts. So please park this concept properly. Is this clear? Can we move ahead? Okay. I am not dealing with this right now. We are going to talk about it when we are going to do the property, the partnership and the S corps taxation. Okay. So people who are doing it from, I think, Becker, I would want you to park it right. Okay. They have given you some sims also on this. At least in the book it is there. It's not there in the database. But I would want you to park this. I'm not going to talk about it here. Okay. So if I look at it, I have dealt with everything in gross income after today's session, except three topics. The IRA income, again, I think even in gross income, there's a small section of IRA income on which they have tested you. We are going to do it later with the adjustments. I'm going to do it. The second thing that I have not done in gross income is your loss limitation rules. We are going to do this at the time when you're going to do partnership. We are not going to do it now. So this is for people who are following Becker. Even this, I think there is a new world. And in the end, if you have what you call it, this capital gains, this is there in New World in great details at the time when you're doing gross income. I'm not doing it now. I will do it at the time of property taxation. Why am I saying this to you? Because when you do the MCQs, I don't want you to park the MCQs. I want you to finish all the gross income MCQs after today's session. But if you get a question, now you'll be able to identify that this is not what we have done. If you have not done this, you will leave this, but you will mark it so that you'll come back to it later. Okay. Now, see, I'll tell you just a small concept. We'll build on this later when we're doing partnership. What they tell you is this: any point of time, if there's a loss, think of it like this. Think of it as like a racehorse. Okay. So this is the start line. This is the finish line. And I've given you two big hurdles to cross. Only if you cross, actually not two, three big hurdles to cross. And only if you cross the three hurdles, then you're going to arrive at the finish line. So the first hurdle is any loss. So what are we talking about? We're talking about a situation which is a loss set off rules. In India, we call it set off of losses. Set off of losses. So there is a loss. Okay. Let's assume it may be a rental loss. Let's assume it's a business loss, any kind of a loss that you suffer. When and under what circumstances can you adjust that loss against other heads of income, if at all? So first we say that the first rule is called the basis, the taxpayer's basis rules. So you have to at least have a basis in the property. So the best way to visualize these kind of problems is through partnership. Partner goes and invests, let's say $10,000 in a particular partnership. Now we know what is a partner's capital account. Right? You remember every time the partnership earns income, the partner's basis goes up. Every time the partner generates a loss, partnership's basis come down. Right? So partnership's basis here is actually equal to partnership account. So here what we say, whatever is his share of income, it will increase. Whatever is his share of loss, it will reduce, and so on and so forth. There's a slight difference. I'll tell you what that difference is. Partnership, as a partner, I am liable for all the loans that the partnership is taking, right? For all the loans that the partnership is taking, if the partnership goes bust tomorrow, I will have to go and I will have to make good those loans, right? So at any point of time, my exposure in the partnership is not restricted to my basis. My exposure is, so here actually there's a difference between partnership account and the basis. Because when you take the capital account of the partner, okay, so typically it is this. I take the capital account of the partners, and to that I will add. So I take the capital account of the partners, and to that I will add my share of liabilities. When I do that, what I get is my basis. So at any point of time, whatever is the loss, I can never get a loss deduction which is higher than my basis in partnership. Now, once this hurdle is crossed, I go to the next hurdle. Okay, there is a basis, but is it at risk? But is it at risk? Okay. Now you want to know whether it is at risk or it is not at risk. When you can't talk about at risk, there you will see if something happens, can you be asked to make good that liability? Then we say, okay, how much of your skin is involved in the picture? So here we'll have this concept of recourse, non-recourse liabilities. And so basically, first is we define the periphery, that is at basis. Then we go a little further and we say, okay, in case if I'm stuck and if the partnership actually goes bust, how much of my skin is involved in the picture? When we talk about, okay, out of this total amount that I'm talking about, how much of it is at risk? Okay, so if it is a recourse loan, you can come back. So if you're a general partner, your risk will be higher. If you're a limited partner, your risk will be lower. So here, generally, the boulders are never, the boulders are never of the same height. Your at-risk basis will be the high, the tax basis will be the highest. The at-risk basis will be lower than the highest, and then at the end you will have the passive sorry then the third hurdle is your passive activity rules. What do you mean by that? I have a business loss. Can I offset it? Okay, first I need to know whether you have a tax basis. Then I need to know how much of it will be a loss in case if you are actually going ahead. And in the end, I want to know whether the income that you're generating and the loss that you're generating, is it a passive loss or an active loss? Because if it's a passive loss, then you can offset it only against passive heads of income. You can't offset it against normal heads of income. So there are three hurdles. When all the three hurdles are crossed, then only you can go and say, yes, I can adjust that loss against other heads of income. Otherwise, no. So I think it's very difficult to let anybody visualize these problems without questions and without some numbers. We are going to do this when we are going to do partnership. So park this. Once you understand partnership, you can use that concept anywhere throughout. Okay. Now, why are we discussing it here? Because there is one small thing that I want to teach you, which is passive activity losses rules for rental real estate. See, a taxpayer is generally considered at risk for money. The adjusted basis of the property contributed to the activity and the money borrowed for use in the activity. So, whatever is your basis, plus whatever is your additional risk in case if you have to foreclose, both of that will be taken into consideration, which is taxpayer's basis and the at-risk rules. Now, what does the passive activity rules tell you? Passive activity rules are very clear. Any kind of a rental activity is a passive activity. A rental activity loss can only be adjusted against passive income, not against other heads of income, which we just saw, right? That rental home that I had that extra depreciation of 3, but I can't knock it off against salaries, wages, capital gains, any of that. No, why? Because it's a active income. I have to wait for a passive income. So next year, when I have a passive income, I will offset it, not otherwise. Any carry forward passive activity loss for whatever time period we're talking about, they can be used to offset the passive income in future years. And if still it is unused, let's say I was not able to generate any passive income, then eventually when I sell off that property, I will be able to use that accumulated passive losses as a deduction against the last capital gain that I get when I sell off that. This is what I was actually aiming at. These are the two exceptions that we have to do in detail. One is a mom and pop exception, and the other is real estate profession, which typically means that general rule, if it's a rental loss, I can't offset it against normal heads of income, except of mom and pop exception and except of real estate profession. That means these losses, that means these rental losses can be offset against ordinary heads of income. That means because of the exception, I will be able to take these rental losses and I will be able to offset it against ordinary heads of income. For example, your salaries and your wages and your interest and your dividends and all of that we just read about. Okay. So what are these two exceptions telling you? So what are these two exceptions? This is what I'm going to get at. The first exception is mom and pop exception. So this is typically, let's say me and my husband, we kind of get into a retirement mode, we invest certain properties. And even though we're not very actively involved, but we kind of do invest certain properties and kind of do something so that by the time we retire, we're able to manage it like a service department. Let's say if that's the rule. So the IRS rules are very clear. They say I will let you adjust $25,000 per year of your passive activity losses if you are actively managing the property, not so much that it will be considered as your active income. So it should like be my side gig. It should not be something that I'm doing like a full blown involvement here. No, you're doing something and you have some amount of your money involved in the property. So you have to own at least 10% of the renter property. Okay. So two things. As I told you, my retirement plan is I will go and invest in a property. So if that is my retirement plan, what do? I say, okay, let me just have a taste of it now. So I'll buy some property and I'll try managing it, but a bit, not too much. So I own the property at least more than 10%. And at the same time, I'm giving some amount of my energies there, but not so much to qualify it as a tip source of income. If both the conditions are met, IRS will let me deduct $25,000 worth of losses. How will you get the loss? Because of spending, right? Because of all those spending against ordinary heads of income. But remember, IRS treats you like a small fish if they're giving you this kind of a deduction. Because the moment it becomes a big thing for you, the moment you become the Priyanka Chopra and the stuff where you feel that you can have 10 properties and you can put all of them on rent, and this is it's getting too much. You don't need this exception. I will roll it back. That's called a phase out in the US parlance. We'll phase it out. That means, you remember I spoke about it in the initial classes. In case of India, the best example is your subsidies, LPG subsidies. If my income is more than 10 lakhs, I sign a form and I say I don't need the LPG subsidy. Here, you don't need to sign a form. The moment your income is above a particular threshold, beep, 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 no passive. So what they say, it is reduced. So this exception will be reduced by 50% of the excess of taxpayers' AGI over $100,000. So see, this concept is very complicated. They will define AGI differently in different deductions. Okay, and the best part is you don't have to get into it. For CP exams, they don't get it so deep. Okay, so what they're trying to tell you is this. Let's say your AGI was $100,000. Your AGI was $125,000. Your AGI was $150,000, and your AGI was $175,000. What is the maximum deduction that you can get? It is 25,000 in all the cases. Okay, so this is the maximum. So when I say maximum exception, it means maximum loss of 25,000 can be adjusted against ordinary heads of income. Now I will phase it out. What is the phase out? Is the income above $100,000? Answer is no. I will get the full deduction. So my deduction will be full. There will be no phase out. So I will get full $25,000 as a deduction. The moment my AGI exceeds $100,000, let's assume it was 125, 50% of the excess will be disallowed. So what is 50%? So 50% of 25,000 will be disallowed. So what will be allowed? The balance 50%, which is 12,500. The moment it becomes 1,50,000, now what is the excess? The excess becomes 50,000. What is the excess of 50,000? 50% of the excess above $1,50,000. So the entire 25,000 will be phased out. You will not get any deduction. Same here, no deduction. So that is why we say the allowance is completely eliminated when AGI exceeds $150,000. Is this clear? We'll do one or two questions from here because this is important. Okay. And this is confusing. You don't understand where are you going to apply this concept. This is an easy rule. Now you are no longer having a passive income. You've become an active. Now, let's say I do it. And generally, I feel men get very overboard. My husband gets very excited and he says, "Oh, let's do this. I will leave my own business. You leave your own business. Let's get into this. This is making a lot of money." I say, "No, I want to keep my head in proper lay. You don't do it. Let me do it." So whatever happens, one of us goes and become a full-time real estate professional. If that happens, now it is no longer a passive activity. So you forget about this 25. Now you're going to treat it like an active income. When does that happen? It happens when more than 50% of the taxpayers' personal services during the year are performed in real estate business. Okay, so I have seen this happening a lot. I have so many colleagues of mine, they get into these what you call it, schools and colleges, alumni, so involved into it that that becomes their part-time job, right? Something like that. Okay, so you are giving more than 50% of your time in that rental activity. Yes, you get more than 50% of the time in that rental activity. And so remember, the and in the or is very important. Okay, and you're spending more than 750 hours of service in that business. Now you're not going to call it a passive activity. It becomes schedule C actually, right? And then you get all the expenses, you get all the deductions, and then whatever is a schedule C loss, you can offset it against other heads of income. So these are the two exceptions which allows you to knock off some part of your rental activity loss against ordinary heads of income, but with some limitations. Is this clear? Everybody, is this clear? Can we move ahead? Okay. Take the first question, okay? What's the call of the question? How much of the rental lots can Brown use, assuming Brown actively participates in the apartment buildings? Brown is a lawyer. He owns 10 apartment buildings that are managed by his brother's real estate business. At the end of the year, the apartment buildings resulted in a $40,000 loss. Brown earned $80,000 in wages. His wife Claire earned $20,000 for her part-time job. Their other income included $5,000 in dividends from their mutual funds. Do you realize they've not given you the AGI? You have to calculate the AGI. So the first question, is it a real estate professional? We are not going to get into that. Why? They've not given you any data, the number of hours that he's spending and stuff. So I know it is not the next exception. If at all, it may be the first exception. Okay? Because he's still a lawyer. They have not told you that he's left his work, right? So he has ownership. So I'm assuming if he's owning 10 apartment buildings, that means his ownership is definitely more than 10%. So he may belong to the first category, but not to the second category, because the second category we don't know the details so much. So we are now testing him for the first category. So he is owning more than 10% and he is actively managing the property. So he may be eligible for the mom and pop exception. So what is his AGI? We take his wages of $80,000. And then you have wife's income, assuming that they are filing a filing jointly return. And then you have the dividend. So this is schedule B income, which is 5,000. So the AGI becomes $1,05,000. Now we know the rules. And here you need to remember the thresholds, guys. Okay, I will tell you where I want you to remember the threshold. This is one provision where I want you to remember the threshold. So I know immediately that this is an excess by 5,000. So 50% of the excess, which is 2,500, will be disallowed. I am generally allowed 25. I will knock off 2,500 from here and 22,500 I'll cast in. I see that you've understood the concept. Awesome. Yes. Next question. Quick. How much of the rental loss? Now, this is the next concept, right? So, first you've understood how much will be allowed, how much will be disallowed. Now, I wanted to understand how are you going to knock it off against other heads of income. Okay. Now, this I think you should be able to answer. Just give me 70 and give me the answer. See, how much of the rental loss can they deduct on their current year joint income tax return? Okay. Margaret received $40,000 in wages, and her husband S had a net gain of 8,500 on a passive. The moment you hear passive, now you should be alert. Partnership interest. So there is a passive activity, and the passive activity income is 8,500. S also had a loss from rental real estate activity in which he actively participated. That loss is $35,000. How much of the rental loss can they deduct on their current year joint income tax return? See, their amounts or the AGI is definitely less than $100,000, isn't it? That means at the max, they will get $25,000 of rental real estate activity, which can be allowed as a deduction. Plus, they will get another $8,500 and they can knock off against passive heads of income, isn't it? The first rule is my total loss is 35,000. First, I will knock it off against ordinary heads of income. So I'll reduce it by $8,500. Okay. Mm, Now, out of this, I will be getting a maximum 25,000, isn't it? So the balance 2,500 will be disallowed. That means I can carry it off under in future. But this year, how much did I utilize full? I utilized this 8,500 and then I utilized this 25,000. So the total amount that I utilized was 33,500. Is that clear? Sorry, not the last one. 33,500. Is this clear? Let's take this example now. This I think is for the last one. See, Clarence, sorry, okay, what's the call of the question? Which of the following statements is true? Okay. See a real estate professional. Now, here they've already given you that this guy is a real estate professional. So, your mind should pick up the keywords, guys. Okay. See a real estate professional. That means already I know that this is the second exception. Owned 10 rental properties. C's real estate activities are his sole occupation, which he works all year. Now, this clearly makes it known to us that it is an active business loss. So, he's a real estate professional. Throughout the year, C was involved. Throughout 2022, C was involved in the operation of all properties on a regular, continuous, and substantial basis. At the end of the year, his rental estate operations resulted in a $75,000 net loss. Spouse had also received $90,000 in wages, and their any other income during the year was 5,000 as interest. So they had a total 95,000 as their joint income or their AGI. How much can they adjust? They can adjust everything because it becomes an active business. So what is the answer for 18? So the answer for 18 becomes A. You can offset the entire loss against your 95,000 heads of income. Why? Because now it becomes an active income, no longer a passive income. Okay? Okay. Now we go to the next concept. Okay. Again, this is a very easy concept. And if you go and look at certain study material, they made it very complicated, talking about a lot of stuff. This is actually very simple. And if you remember, I gave you that concept about insurance, you remember. If you get a tax deduction today, you will not pay tax when you get it back, right? So if the premiums are a deduction, that means I have not paid tax on it today. So when I get that payout, it will be taxable in my hand. If at the time of paying the premium, it don't get a tax deduction, that means I have paid tax on that amount. So when the payout happens, I will not be paying further tax, at least to the amount that I have paid the premiums on. Right? This was the